Yo, what is going on? Welcome to my channel. I am your favorite covered call guy. And for those who are new, welcome to the channel. My goal here is to create $120,000 in annual passive income. I am currently holding 7 holdings. That is GPIX, QDIVO, GPIQ, IWMI, SPYI, QQI, IDVO. And with these 7 holdings, it's currently yielding me about 70 grand a year. And that's translates to about 5.8K a month, 1.3K a week, 193 days. 193 dollars. I keep messing that up every video. And $8.05 per hour, projected, of course, projected. All right. And of course, for those who are new, these 7 holdings are what I'm focusing on for 2026. Obviously, things change. If we have another great discount, I might add another one. I might talk about it in this video, but for this particular ETF I'm talking in this video, I am planning for 2027. Okay, legal disclaimer before we start. So the information presented in this video is for informational and entertainment purpose only. It should never be construed as financial, legal, tax, or investment advice because I am not licensed financial advisor, accountant, or attorney, and no professional relationship is being established through this content. All opinions expressed are strictly my own and do not constitute recommendations to purchase, sell, or hold any securities or financial instruments. Viewers are strongly encouraged to conduct their own due diligence, do your own homework, do your own findings, come to your own conclusions, comment below and correct me if I'm wrong. All right, critique me. All right, and if you're gonna buy anything, consult with a qualified professional before making any financial decisions. If you choose not to, again, that is entirely your call, but don't say I didn't warn you. I am just some random idiot you found on YouTube, and I could be completely wrong. With that out the way, let's get started on today's video. It is the battle of different strategies. Yes. I keep stressing this, right? Oh, don't worry about the overlay. Don't worry about the overlap. Worry about the different strategies. And let's talk about which ETF strategy compounds better. I'm talking about holding for the decade. Possibly which one. Okay. Ticker symbol OVL or SPYI. And I'm going to be talking about OVL a little bit more just because, hey, that might be the stock to buy for myself in 2027. All right, let's look at the ugly truth. And I like to start with the bad first. Knock it out the way. All right, this is just talking about the ETF landscape, which has fundamentally altered yield generation and risk for us millennials and, of course, the Gen Z, right? We are no longer caring about the 60-40. We don't really care about the bonds and the fixed income, right? The traditional dividends that yield 1 or 3%, right? We have much more complex derivative income now, and it's flooding the market, right? The problem is that most people do have zero clue on what structural risk they are actually buying, right? They see the yield, they see the numbers, they see how much it can pay, and they just buy. So I'm gonna be tearing apart very 2 complex heavyweights, right? OVL and a SPYI, so you know exactly what is happening underneath the hood and what is my thought process on why I might buy OVL in 2027 or in 2026 if we get another nice dip. All right, the 2 different beasts, right? So let's look at OVL. I'm gonna say OVL is the accumulator. What do I mean by that? Well, looking at their strategy, it does function as a bullish to neutral total return enhancer. Okay, from what I'm looking at and how it's actually operating, I do think it utilizes put spreads to synthetically generate yield on top of equity. Okay, but make no mistake, please. Equity exposure comes first. Income is strictly secondary, which is a good thing. You guys know I do love a little bit of my uncapped, right? I do love my GPIX. I do love my GPIQ, and I do love my QDIVO, right? Give me the principal first, grow my NAV, and give me income second later. Even though I am a pure income investor, hey, I'm still getting income. It's just not as much as you guys are wanting the 15, 20, and 25, 30%ers, right? So OVL versus SPYI. I'm going to say SPYI is the distributor, right? Of course, we all know and love the NEOS fund, SPYI and QQI to be exact, right? The 2 most popular one, right? They operate more as a neutral to defensive income maximizer. I don't know. I'm pretty sure almost 99.9% of people of you guys will agree with me on that stance. Okay, it does rely heavily on call spreads to aggressively harvest premium from the market. This is how they have to, this is how they make the 12% yield, right? 12-13% yield, right? Premium harvesting is their absolute main goal. They will try to save the NAV, they will try to grow the NAV, but their main goal is to give you income first, and of course equity appreciation does sit on the back seat. All right, so let's look at OVL bullish engine. It's very important, right? OVL holds VU. Everybody loves VU VU and chill, right? So again, it's giving you ultra low cost delta 1 perfect tracking of the broader market, because that's what VU does, right? And so on top of that rock solid base, because VU is probably the most foundational ETF on the planet, right? What OVL does, again, I could be wrong, but I do think they sell short put to generate immediate cash flow. Okay, that's very crucial here. It also buys a lower strike put to cap your downside risk. Why does this matter? Because physical equity books do capture 100% of the market's upward momentum without any ceiling. So this is, they're playing, they're playing the more bullish to neutral side of VU, which is great. SPYI is more defensive, right? I want some upside capture, which uncapped upside capture. Okay, uncapped upside capture. Okay, that was a tongue twister for me, right? And that's what OVL does. That's all. That's something I want to kind of continue to build my investing thesis around, my portfolio, right? Give me a little bit more uncapped growth, right? Income doesn't have to be the highest. That's okay, right? I'll just invest a little bit more, and if I got to work an extra year or two, that's fine. All right, SPYI's defensive income. So again, I'm pretty sure a lot of you guys will agree with me on this. SPYI physically buy the individual stock that make up the S&P 500 benchmark, right? Then it layers it with a data-driven cover call overlay to generate the targeted massive high yield distribution. That's how they make their premium, right? I do think maybe a lot of people don't know about it, but they do. This is the uncomfortable catch that a lot of people have to understand, that writing cover calls inherently capture capital appreciation. Yes, they do have some call spreads to kind of capture a little bit, but with the sharp V shape, it won't capture much. It will get capped, right? If the market does rip higher, we've seen that. You guys seen it. It does kind of cap itself. Okay, what is the convexity catch here? So exactly, it just means asking ourselves, how do these funds handle a massive market melt-up and extreme right tail return? Well, let's look at OVL. OVL leaves upside completely uncapped. I need some of that, okay? I do want to get that nickname off myself, and the capped cover call guy, right? So I'm gonna be all right. Maybe OVL can help me kind of be a little bit more uncapped. And what that means is I'm gonna get a bit more full equity beta exposure plus the option premium decay, right? As long as the market doesn't breach the put strike. If it does, obviously I'm going to buy more of OVL. That's fine with me. That's cool. All right, SPYI caps the upside, but Neil's figured it out, right? They do try to fight back a little, okay? What it does is it just purchases further out the money calls to create a spread, right? Aiming to restore some of those right tail return, okay? So looking at the stark reality here, SPYI recaptures partial upside during violent surges, right? That V shape. Go check my YouTube post. I post a screenshot of my portfolio. Literally, that's the V shape. That's the best V shape you can look at, right? But it does remain fundamentally capped compared to OVL's limitless ceiling, which I need some more in my portfolio. Okay, let's look at option Greeks decoded, and we're going to look at delta. All right, delta, essentially, it just measures directional bias, right? OVL adds positive delta by selling puts, so it's acting essentially like a leveraged long vehicle up to the short strike, while SPYI introduces negative delta by selling calls, right? So mathematically reducing your overall equity beta. So one kind of leverage long and the other is kind of dampen it. Okay, let's look at gamma, theta, and vega, right? So gamma is the risk. Both funds hold negative gamma because they are net sellers, right? However, their long protective leg prevents infinite losses during a violent market crash. What is theta? That is the time decay, right? Both of them harvest time decay. They're both they're both options, right? They act as an insurance provider, right? We're the house, we're the seller, we're selling to the buyers, right? So as long as more time passes, the better for us, okay? The house wins when the clock ticks down. And vega is just volatility, right? Volatility is how much it swings up, swings down, or just choppy sideways. That's volatility, okay? Both carry negative vega, meaning negative volatility. So if the VIX suddenly spikes, then both funds will suffer immediate temporary mark-to-market drawdowns in their overlay value, okay? It just depends how it spikes. Okay, let's look at the volatility premium. What I mean that 4.2% structural premium gap. All right, so why does OVL actually work, right? Look, we just have to find, we follow the trends, right? Financial markets exhibit massive mathematical inefficiency. And historically, IV, implied volatility, has consistently exceeded realized volatility. Well, that just means that if you follow big money, smart money, institutional investors are behaviorally driven to overpay for tail risk catastrophe, right? The house collects this premium for us. Think of the house as the hedge funds or the ETF issuers, right? We sell the premiums, we sell the options to collect the fat premiums because of fear. That's it. They panic buy puts because, hey, the market's overvalued. The market's it's too high, it's too much, it's gonna crash, it's gonna crash, right? So OVL just exploits this structural supply and demand imbalance, right? Everybody does want to buy a piece of VU. Maybe not at this price. Maybe they want it $50 cheaper. So that's what they do. They hedge against it to buy the put spreads, right? That's why the OVL can pay out the 10% yield because of this, right? This is where they're getting the fat, juicy premiums. All right, let's look at the cover call reality. So SPYI monetizes directional exposure. So it fundamentally trade away your assets appreciation for potential immediate cash flow. There's a problem with that, right? The problem is that right now the market is saturated with yield-starved retail investors like myself. I was that guy. I was that 1 to 3% dividend yield investor. I was that guy. But looking at data, because you know I do love using historical data, okay? Long-term data consistently prove one thing. Put writing strategy delivers higher absolute risk-adjusted returns than call writing. Now, I'm drawing the picture here, right? I'm drawing the picture here. OVL versus SPYI. Now we're starting to see a difference in their strategy, right? Let's look at the crash mechanics and leverage. So let's look at the SPYI buffer, right? Why is it so popular? Well, because SPYI does provide a tangible downside buffer, right? The intrinsic premium collected, you know, the cash given out to you from short call offset the linear equity losses, right? It cushions the fall initially. Let's look at OVL dual losses. Right, as much as I'm talking so good about OVL, right? OVL in a severe crash does suffer dual losses mechanic. What does that mean? One, your physical index declined. And on top of that, the short put moves into the money, right? Realizing its max loss. So you lose on both ends for that. Of course, there is Rule 18F TAC 4. Not a tax advice, not a professional, not financial advice here. I could be wrong on this. SEC rules legally caps OVL's synthetic margin, okay? That could be a good thing, right? This is ensuring value at risk doesn't exceed 200%, which is still crazy, but you know, give or take it, I would say this is a good thing, right? It won't cause systematic ruin, but a crash will still sting. You're still gonna feel it. You're gonna see your portfolio swing one way, depending on how big your sizing is. Right, taxes and yield expectation. Of course, we know SPYI with a 12% target uses section 1256. Gives you 60% long term, 40% short term, and it does aggressively use return of capital. Okay, so again, for even for those who are new to income investing, you've probably kind of, if you've done your own, just even a little bit of your own due diligence, you would know SPYI is great on the yield. It is great on the NAV appreciation. It is great on the taxes, right? If return on capital, right? You can defer taxes and compound pre-tax for years or decade. Versus OVL. Now, right now, I'm putting it in the 4 to 5% range because I'm using TTM, right? 12-month trailing. But they're on their website they're saying it's about a 10% distribution yield. But I'm just right now using the 12-month trailing. It's about a 4 to 5% range right now. Okay, its primary structure is total return, meaning its overall tax burden is naturally lighter. That's a good thing, right? Lighter tax burden. I mean, I don't want to pay taxes. Right, also relies heavily on rock for its lower variable distributions. Now, if you like rock, this is a good thing. Okay, the vast bulk of your returns remains unrealized capital appreciation sitting in the VU base. So it's kind of like owning a piece of VU while getting a juiced up yield. I mean, hey, I want to own a piece of America while getting paid. That's always a great thing for me, at least in my opinion. You can argue with that in the comments. Let's look at the math of compounding. I'm gonna say 30 years because on this channel, when I buy something, I always think about the 30 years I'm gonna hold it for. I don't have any intent to hold it for less than 30 years. If you have the same mentality as me, you and I, we're gonna do well together. All right, continue to support the channel. I need your support because we are the long-term investors here, right? So again, this is my scenario here of over decades. I do think that OVO functions as a pure total return enhancer, right? Uninhibited right tail exposures does allow for geometric compounding without friction, meaning it's uncapped. Remember what I said? It's uncapped. Just let it ride, okay? SPYI intentionally, it's a feature, not a bug. It will have to sacrifice some right tail participation, right? This is suffering from convexity drag that mathematically impairs long-term wealth accumulation. Okay, OVL is there for you to go ahead and just say, buy me. You own a piece of VU with a little bit of extra juiced up yield. That's it. That's it. Sorry if I'm shaking the mic. I banged on it. All right, let's look at the regime dependency matrix. Okay, this is just again my scenario and expectation. Okay, if you look at here, the strong bull market, OVO outperforms. Grinding bull market, moderate outperformance by OVL. Sideways to flat, I'm gonna say OVL does a little bit neutral to positive here, and a sharp drawdown. All right, this is when OVL does loses, right? Significant underperformance because their put spreads will get breached, and that's where they do have to end up paying out. And you know, if your contracts get breached, obviously you have to make the payout, right? So it does win 3 out of 4. In my opinion, that's great, right? I mean, that's not bad at all. Still great compared to SPYI. Still winning 3 out of 4. Not bad at all. I want you guys to look closely at this. This should help you draw a conclusion. If OVO is winning 3 out of 4, but does bad in my opinion, the crash, but versus SPYI that still performs quite well out of 3 out of 4 markets, right? But does very bad in a strong bull market. What do you guys think you should be doing here? Leave in the comments below. I want to see if you guys have the same thought I do. All right, I'm holding until I'm 90. Okay, so this becomes the question now: which one should you buy? Again, it entirely depends on your timeline and behavioral tolerance. All right, let's look at OVL. Like I said in the beginning, I'm just summarizing everything now, right? OVL, in my opinion, is the accumulator. For its strategy, I think it's structurally optimal for the aggressive investors who want to prioritize uninhibited capital appreciation and compounding total return over decades. Okay, SPYI, like I said, it is the income maximizer. Okay, its strategy, it's structurally optimal for retirees who need sustainable, tax-efficient portfolio distribution right now to survive sideways markets. Okay, if you guys, from the previous slide right here, look at this and compare it to these two, right? I think OVL is a great pair. Don't buy one over the other. I think these two supplement each other. Their strategies differ, so one wins in a bad market, one wins in a great market, and you still get paid. I hope you guys got something out of this. As you know, yes, I'm pretty sure there's gonna be a comment below. Oh, you're making another OVL video? I'm giving you hints, man. I'm giving you hints. I'm probably very close to buying OVL if it comes to the price that I like to get my entry price in. I'm just letting you guys know. I do have plans for it in 2027, but if 2026 gives me a great dip, crash, correction price, I'm going in. If I have dry powder, I'm going in. All right, thanks for watching, guys. Appreciate all of you guys. Hopefully this was informational, creative. You got something out of it. Again, if you did, please support the channel. If you're new, subscribe, comment, like, and leave your thoughts. I read all comments. I don't delete anything unless it's fraudulent or spam or scammy. Then those get deleted, but I do not delete any comments. I appreciate all comments, love or hate. Thanks for watching, guys. Stay tuned. Catch you guys on the next.